Have you ever wondered why the exact same paycheck grants freedom to some, yet traps others on an endless financial treadmill? After 40 years of building, losing, rebuilding, and then compounding more wealth than I could ever spend, I assure you the solution isn't fatter paychecks, high-stakes trades, or secret hedge fund contacts. It rests on 7 age-old money principles, so steadfast they carried my ancestors through exile, economic collapse, and 2 world wars, principles most people today ignore. Over the next 20 minutes, I'm handing you the very blueprint that quietly transforms average earners into million-dollar grandparents, while the rest chase flashy shortcuts destined to fail. Skip even one rule and everything unravels. Master them all and recessions lose their power over you. Here's a sobering fact. 78% of adults in developed countries live paycheck to paycheck. Doctors, engineers, even entrepreneurs pulling in 7 figures, they're all one setback away from begging lenders for relief. Meanwhile, a tiny slice of the population, just 2% of Americans, produces the lion's share of self-made millionaires and also gives more per person than any other group I've studied. Their edge? They follow a code that flouts consumer trends. Discipline outperforms income. Character eclipses credit. I learned those rules at my grandmother's wooden kitchen table long before my first 9-figure exit. She slid 3 weathered envelopes across the wood, one marked future, one giving, and one today, and said words I only understood decades later. Money is a soldier. Without orders, it dies on the wrong battlefield. Most people never deploy their troops. They scatter them at the mall or surrender them to debt. That's why their armies vanish when real battles, job loss, market crashes, medical emergencies arrive. If your pulse jumps every time a bill hits your inbox, you already know what's at stake. The real question is, are you ready to trade financial anxiety for unshakable control? Rule number 1 starts with 3 simple words. Live below means. This isn't tired budgeting advice, it's a radical shift. True wealth begins the moment your ego ends. I've seen surgeons earning $500,000 a year drown in overdraft fees, while a janitor at the same hospital retires owning a paid-off duplex and collects dividends large enough to send 2 grandchildren to college. The difference? One spends to impress strangers, the other spends to empower his future self. My first mentor drew a single line on a napkin, income above, expenses below, then handed me a pen. If those lines ever meet, tear this napkin in half, he warned, because that's when your freedom fractures. I was 23 and leasing a German car I could barely pronounce. That afternoon, I canceled the lease, sold my watch, and squeezed into a studio so small its door hit the bed. 2 years later, I invested those savings in a regional bank whose stock then multiplied 5-fold after a merger. Ego would have bought luxury seats. Discipline handed me my first million. Here's your actionable checklist. Cap your lifestyle at 75% of take-home pay. Automate transfers the moment your paycheck arrives. Audit every expense line by line each quarter. Craving that daily latte? Go for it. Just remember, $5 a day adds up to $1,800 every year. Imagine holding 50 shares of an index fund that has reliably doubled in value every 10 years. The choice is straightforward. Settle for fleeting satisfaction today or secure lifelong freedom tomorrow. Think about one non-essential expense you can cut this month and announce that decision publicly, making it real in your mind. I'll be cheering you on as you commit. Debt is a thief disguised as convenience. Each time you swipe, it whispers, "No rush, pay me later," then lurks in the shadows, compounding at 20% interest while you sleep. By dawn, it has claimed part of your future, and it never settles for just a nibble. In my 20s, I borrowed $30,000 to scale a business that wasn't ready. The venture collapsed, but the interest never took a day off. For 3 years, every Sunrise's first dollars went straight to the bank. That ordeal etched an inviolable rule into my financial playbook. If an asset depreciates, pay cash. If it appreciates, negotiate equity. If you're unsure, walk away. Since I adopted that creed, I haven't paid a cent in consumer interest, and my net worth has grown 20-fold. Here's your action plan tonight. List every debt you carry. Pay only the minimum on lower rate accounts. Throw everything extra at the debt charging the highest rate. Sell unused items, pick up extra hours, cut takeout, and weaponize every surplus dollar until that high-rate balance surrenders. Freeze your credit cards in a block of ice at the back of the freezer if you have to. Each time you reach for them, you'll remember that wealth is what you refuse to owe, not just what you own. Picture waking up with 0 monthly payments, no cards, no car loan, no lingering medical bills. How liberating would your Monday feel? That reality is closer than you think, once you decide that interest will never outrank your priorities again. Ignorance is the most expensive asset you'll ever own, because it quietly compounds losses while you congratulate yourself on knowing enough. In my 40s, after reaching an 8-figure net worth, I still lost $2 million on a single deal because I skimmed the term sheet instead of studying every line. The tuition was brutal, but it purchased a lifelong habit, dedicating at least 15 minutes to fresh financial education each morning. That habit rewired my thinking. I devoured books on behavioral economics, audited courses on tax strategy, and most importantly, taught these concepts to my kids over Sunday breakfast. You can't truly master a concept until you explain it. If you can't make compound interest clear to a teenager, you don't understand it well enough to retire on it. Your next steps. Block out 15 minutes daily for reading or podcasts. Keep a notebook titled My Money Playbook and jot down one insight each session. Share a single takeaway with a friend every week. Speaking it cements it in your mind. Turn your kitchen table into a classroom and lock that knowledge in. Coming up, Rule 7 reveals a 1-page document that has shielded my grandchildren from losing half their inheritance to taxes and lawsuits. Skip that tip, and the wealth you build could vanish in probate. Before we move on, reflect on the last book or podcast that upgraded your money mindset. Your recommendation might be the lifeline someone else needs right now. Think of your wealth as a 3-legged stool. One leg is stocks. The second is real assets, property, commodities, private businesses. The third is liquid reserves. Remove any leg, and when the economic floor tilts, the entire stool collapses. I learned that lesson in 2008, when friends who thought they owned 5 rental properties discovered the bank actually held title to 4.5. They had all their assets riding on a single leg, and it snapped overnight. A time-honored rule teaches us to split our portfolio into 3 equal parts, so that one financial storm can't drown the entire ship. In modern terms, friendly, clear, and reassuring, creating a calm atmosphere and making the listener feel confident and comfortable. Clear, articulate, and steady, ensuring each instruction is easily understood while maintaining a natural conversational flow. Emotion. Warm and supportive, conveying empathy and care, ensuring the listener feels guided and safe throughout the journey. In modern terms, dedicate 1/3 to growth, like broad market index funds or companies that keep boosting dividends. 1/3 to stability. Think real estate, top-tier bonds, or profitable small businesses you actually understand. And 1/3 to liquidity, cash, money market accounts, short-term government bonds, so you're primed for bargains or emergencies. Stress test your situation right now. If your main holding plunged 30% tomorrow, could you still sleep soundly? If not, rebalance before the market forces your hand.
Remember, it's not about chasing the absolute highest return. It's about surviving the knockout punch without getting taken out of the game. Here's a swift assignment. Open your net worth statement tonight and tag every asset under growth, stability, or liquidity. Spot a category carrying too much weight? There's your next strategic move. Cash doesn't lie. It mirrors your habits down to the last penny. Yet most of us avert our eyes, too scared to face the truth. I was no different until a mentor dared me to track every single cent for 30 days. By the second week, I realized my daily pastry habit was costing $900 a year, plus a streaming bundle draining $600 more. That small audit unlocked $1,500, which I funneled into an index fund that's now worth over $30,000. Now it's your turn. Launch a 7-day money X-ray. Whatever you spend, every swipe, tap, or cash transaction, note it within 60 seconds. Use a notebook or an app. The key is immediacy. At week's end, sort your expenses into 4 categories. Survival keeps you alive. Security builds your future. Service grows your community. And self-indulgence covers everything else. This isn't about guilt. It's about control. Once you spot the leaks, seal them and redirect funds into security and service. It takes only 10 minutes each week, yet that discipline separates those who wonder where their paycheck went from those who tell every dollar exactly where to go. Coming up shortly, a simple generosity habit that unleashes opportunities beyond what any spreadsheet can measure, but only if you accept that giving is a growth strategy, not just an expense. It may feel counterintuitive when you're grinding, but generosity is the lever that lifts you higher. My grandmother called it the open hand principle. A closed fist holds on to what it has, but blocks everything new. At 29, I put her advice to the test. I committed 10% of my stagnant consulting fees to buy college textbooks for first-generation students. In just 12 months, my revenue doubled, not by magic, but because giving widened my network and sharpened my purpose. Here's a blueprint. Choose a percentage. Start with 2% if 10% feels too steep. Automate the transfer the moment your paycheck lands, so emotions stay out of it. Channel those funds into causes that resonate with you and involve your family in the decision. Kids who grow up practicing structured generosity learn to see money as a tool, not a master. And remember, giving isn't limited to cash. Mentor a young professional. Introduce 2 friends who can help each other. Offer your expertise. True wealth goes beyond digits on a screen. It lives in the strength of your relationships. Take a moment to reflect. Who will you lift up this week, and how could that act reshape both your story and theirs? Then put your plan into motion. Think of tomorrow as a contract you've already signed. Whether you read every clause or not, one accident, one lawsuit, one market crash can wipe out decades of progress, unless you build your defense today. Too many families get stuck in probate because someone neglected to draft a will. Entire legacies have been halved when heirs battle over assets without clear direction.
My own safeguard rests on 3 essentials: a living will, an advance healthcare directive, and a durable power of attorney, each reviewed every 2 years. I carry a term life insurance policy large enough to eliminate every debt and cover college tuition for each grandchild. All my passwords, account numbers, and a detailed letter guiding my spouse through the first 60 days if I never return live securely in one binder. Protecting your legacy isn't just about money, it's about providing clarity. Pick one weekend this month to create or update your estate documents. Designate both primary and contingent beneficiaries. Keep one printed copy in a fireproof safe and another encrypted in the cloud. Then have an honest conversation with your loved ones, not just about who inherits what, but about why those assets exist, to buy choices, to buy time, to buy freedom they can pass on next. Now let's debunk 5 widespread money myths. 1. I'll start investing once I earn more. Discipline on a modest salary will outpace reckless spending on a hefty paycheck decade after decade. Begin with $10 today. The habit matters more than the amount. 2. My credit score is an asset. It's simply a lender's forecast of your profitability. A top score only counts if you carry 0 consumer debt.
3. Diversification dilutes returns. Focused investments build fortunes, diversification preserves them. While you're still growing wealth, spread your income streams, then concentrate on your core expertise. 4. Budgeting feels restrictive. Actually, it gives you permission to spend boldly on what matters by cutting everything else. 5. I'll give to charity when I'm rich. Delaying generosity robs you of relationships and goodwill that accelerate future gains. Giving is a growth engine, not a burden. Ready for action? Here's a 7-day sprint. Day 1. Track every expense for 24 hours. No judgment, just raw data. Day 2. Slash one unnecessary cost and reroute that exact amount into your emergency fund. Day 3. Cancel or destroy the credit card charging the highest interest rate. Day 4. Read 10 pages of a personal finance classic and teach the main insight to a friend. Day 5. Invest $50 or whatever you can into a broad market index fund. Day 6. Schedule an automatic transfer, even $5, to the cause you care about most. Day 7. Draft or update at least one legal document, a will, beneficiary form, or power of attorney. Actions separate spectators from achievers. Consider Gerald, a high school custodian whose annual income was smaller than what some parents spent on a single vacation. Each payday, he lived on 70% of his earnings, avoided debt completely, and funneled the rest into a low-cost index fund. Colleagues teased his faded sedan and brown bag lunches, but quarterly statements piled up in his desk drawer. Every month, he read one investment book, logged every penny, tithed 10% to a scholarship fund, and kept his estate details current. After 4 decades under fluorescent lights, he retired with $8 million, enough to buy a lakeside cabin outright and endow scholarships for future students. That's the payoff of patience, precision, and purpose. The neighborhood paper hailed it as miraculous, yet Gerald insists it was simply arithmetic wrapped in persistence. His journey shatters the myth that building real wealth demands genius or glitz. It hinges on habits so mundane most people scroll right past them. If a custodian can secure a financial dynasty with a broom in one hand and compound interest in the other, what excuse remains for you? Fast forward a decade. You never adopted these 7 principles. Credit card bills still whisper your name. Your investments wobble on a single pillar. Your kids inherit chaos, not clarity. Now rewind and replay those 10 years, living by the rules. 0 consumer debt.
A 3-pillar portfolio humming through market highs and lows. A giving record thicker than your tax filings. Which future sits lighter in your chest? Millions already chose that second timeline. More than 20 million brokerage accounts grow quietly each day. Over $4 billion flow annually through automated donations. Estate planning filings are up 30% since the last downturn. Ordinary people, teachers, nurses, gig workers are proving every rule works right now. The only variable left is you. In 10 years, you'll either attest that these guidelines saved your financial life or wish you'd started when someone challenged you to act. Question 1. I'm 45 with 0 savings. Am I too late? Not if tonight you automate 15% of every paycheck and refuse new debt. Compound interest still has 20 years to multiply your funds. Add a side hustle and you'll outpace those who began earlier but coasted. Question 2. Should I kill my mortgage or invest instead? Apply the sleep test. If owning your home outright gives you deeper rest than 1 extra % of return, wipe out that mortgage. Peace is a dividend no spreadsheet can measure. Question 3. What about gold or cryptocurrency? Treat them as insurance, not salvation. Cap exposure at 5% unless you can draft a 10-page analysis on their risks. Question 4. How do I help my adult children without enabling them? Match their savings 1 for 1. Fund courses instead of consumer purchases. Require a written plan before releasing capital. Empower vision, never rescue avoidance. Question 5. How do I bring a reluctant spouse on board? Swap lectures for curiosity. Ask what financial freedom looks like to them. Then work out how the 7 rules fast-track that vision. Shared dreams fuel shared discipline.
Now, a 5-minute morning protocol. Step 1. Grab yesterday's ledger, paper or app, and scan your net cash flow, 30 seconds. Step 2. Read a single paragraph of financial insight, a quote, book excerpt, or newsletter clipping, 30 seconds. Step 3. Speak your top money goal aloud. 0 consumer debt by December 31st or 2 rental properties in 24 months, 10 seconds. Step 4. Choose one concrete action for today. Cancel a subscription, schedule a side gig call, or move $50 into your brokerage, 1 minute. Step 5. Close your eyes and spend 90 seconds feeling the relief future you will enjoy when this action compounds. Anchor that emotion. Motivation follows feeling, not logic. Spend 5 minutes at sunrise for 30 straight days and watch your decisions align like iron filings around a magnet. Which question or step resonated most? Reflect on it and lock it into your routine. You now hold 7 time-tested rules, a 1-week sprint, and a 5-minute morning ritual. They cost nothing but attention and will reward you with freedom every breath you take. The next move is yours alone. Decide right now, will you let this message slip into the background, or will you lock in one powerful habit before daylight fades? Take the leap. Embed that new routine immediately. Sometimes frustration rises so high you want to strike out at someone, or even turn that fury on yourself.